Good morning, welcome to Catex TV. My name is Frank Fortunato. Today is Friday, the 21st of November, 2014. You can follow us on Twitter at catex.com. It seems as if Russian companies are facing billions of dollars in extra insurance costs now as Western sanctions prompt foreign insurance firms to start pulling out. Their concern is that any business they undertake in Russia is at risk from future measures, i.e. sanctions, and an increasingly perilous Russian economy. Existing sanctions, along with the decrease in the price of oil, have brought Russia to the brink of recession. The ruble's down about 30% over the year. Foreign insurers are concluding that it's simply not worth the risk of offering their services, according to sources in the industry. A broker at Willis, Andrew Vandenborn, said there's a concern that further sanctions could be imposed, and there is uncertainty about where they might be imposed. If insurance companies were to write credit risk for Russia, even if the companies are not sanctioned and they were to default, they would have a difficult conversation as to why they chose to write the business to begin with. This is going to pose an increasingly difficult problem for Russia. There's approximately $15 billion of Russian loans that are exposed to insurance markets in London, Bermuda, Singapore, and New York. There was an explosion in an oil and gas platform in the Gulf of Mexico yesterday. It killed one person and injured three others. The platform was not in active status. It's owned by the Houston-based Fieldwood Energy Company. The Coast Guard has so far found no pollution emanating from the explosion. In Mexico City yesterday, there was a huge protest as thousands of people threw Molotov cocktails and clashed with riot police outside Mexico City's National Palace. This is all people protesting the government's handling of the apparent massacre of 43 trainee student teachers. There was another attempt to set a fire to the main doors of the National Palace. Police managed to push them back using tear gas, and then Molotov cocktails began. The Chinese central bank this morning announced a surprise cut in interest rates. It's the country's first cut in more than 2 years. It's the clearest sign to date yet that policymakers in Beijing are growing increasingly concerned over the pace of China's economic slowdown. They cut its benchmark rates by 25 basis points down to 2.75%. Three U.S. wholesale firms, CRC, Amwins, and Sweat & Crawford, have launched a new $25 million public directors D&O program for liability insurance at Lloyd's. They're going to have a $25 million cap, I said, insofar as premiums taken in. They're going to start binding effective December 1st. Endurance Specialty Holdings down in Bermuda, John Charman's company, has announced a dividend of 34 cents a share. And China Re has announced that its applications to be a standalone Lloyd syndicate has now been formally approved. It will begin writing effective January 1st. It's going to be managed by Catlin underwriting agencies. Meanwhile, it seems as if somebody's doing well. Volkswagen has just announced that they're going to spend $106 billion to upgrade its car operations over the next 5 years. They said that the cash flow will go into developing more efficient vehicles and production methods. They're also going to expand the capacity at its plant in Poland, as well as a new plant in Mexico where they manufacture Audis. That's the news for today. If we have any breaking news, we'll come back and tell you. Thank you for watching, and we'll see you tomorrow.